All right, good morning, everyone. Thank you for joining us. As you all know, we are a very interesting time right now with the COVID-19 outbreak. So the Indiana SBDC has been utilizing Zoom technology as well as many other organizations doing that. And so we wanted to be able to bring you a webinar today so that you can be more connected to the services that are offered to you as a small business owner or someone who works with small business. So thank you for joining us today. We are hosting a webinar, Understanding Financial Statements for Small Businesses. This event and webinar is hosted by Radius Indiana and the Gail and Bill Cook Center for Entrepreneurship. So I'd like to do some introductions. So first, my name is Keely Stingle. I'm the Vice President of Talent Attraction and Retention for Radius Indiana, and I also serve as an Indiana SBDC Business Advisor. Radius is a regional economic development group that covers 8 counties in South Central Indiana. And we work to promote the region as well as working with small businesses and working with workforce development needs as well as business and economic development. So with that, today we're going to dive more into financial statements for small business. We have our presenter, Troy Phelps. I'll pass that over to Troy so he can introduce himself and then pass it over to Jack as well.
Thank you, Keely. Good morning, everybody. As Keely mentioned, I'm Troy Phelps. I'm the Assistant Director for the Gail and Bill Cook Center for Entrepreneurship, part of the Ivy Tech Community College in Bloomington. We are also the host for the Indiana Small Business Development Center, so we specialize in doing a lot of low cost and free business advising, training programs, seminars, those kinds of things. Joining me is Jack Dreesen. Jack, I'll let you introduce yourself.
All right, thanks, Troy. Hey, everybody. My name is Jack Dreesen. I'm the coordinator for the Gail and Bill Cook Center for Entrepreneurship at Ivy Tech Bloomington. Today, I'm going to be the one behind the scenes for this webinar presentation. I'm going to be taking care of all the back of house Zoom session stuff. And just to go along with that, I have everybody on mute that's coming in, all the guests. But if you want to ask questions, and we highly encourage you to do so, please ask in the chat. If we have time, I'll definitely pass those along to Troy during the presentation. Or I might just ask you to ask it yourself. So if you do want to ask it personally, just let me know, and I'll make sure to do that. Aside from that, I think we're ready to roll.
All right, great. All right, so we want to go over some of the goals for today's webinar. So we want you to leave here with 3 things. One, being able to understand the 3 main financial statements that most businesses use and how to avoid the most common mistakes, and also why those are particularly important. Next, we want you to leave knowing some of the common accounting ratios and what that formula is to get those. And lastly, we want you to know what financial institutions are looking for. So if you need access to capital, what information they're going to be looking for from you as a small business owner. So Troy will cover each of these different topics. At the end of each of those topics, he's going to pause to take questions. So if you have questions about those specific topics, know that we will be answering those throughout the presentation. And if you would like to, if something comes up later, feel free to ask it at any time, and Jack will be the one fielding questions and asking you if you want to ask that personal. So with that, we'll get started, and I'll pass it off to Troy.
All right, perfect. Okay, so as we jump right into this, I just want to set the stage a second that what this class is not going to be. It is not going to be a lesson in accounting. One of the biggest things that I deal with all the time is people stress out because they think, wow, I don't understand accounting. I don't want to know accounting. I want to run far and fast away from it. So with that in mind, what I am going to do is talk about the 3 main financial statements first and kind of give an oversight of what each one is, the role it plays, what information's on there, and most importantly, how you can use it to help you manage your business. So let's go for it. The first one is the income statement. Then we're going to talk about the balance sheet, and then the cash flow statement. So first up is the income statement. Well, depending on who you talk to, it could be, they could mention the income statement. They might also mention a profit and loss statement or a P&L, a statement of revenue and expenses. All of those are referring to the same statement. So it really depends on who the source is that is presenting the information, who the audience is. For example, if you talk about accountants, they might call it an income statement, especially if they've got they've been in accounting for a long time, because that's kind of what accountants are trained to refer to. But in my mind, it's really the statement of revenue and expenses is really what describes it the most, because that's exactly what it is. It discloses the revenue and expenses. The thing about an income statement that sets it apart is it measures a company's financial performance over a specific period of time. So it shows net profit over a specific period of time, which is usually a month, quarter, or year. And when I say this, I mean a balance sheet is a snapshot in time. An income statement is designed, and really it's only effective if you present it over multiple days, weeks, months, sometimes even years, because it's meant to give you a picture over that period of time. So that's one of the big differentiating factors on this, is it covers a period of time. Now, when we're talking about an income statement too, it's important to know that no two ones of these look exactly alike. Because that's a nice thing about these. They can be structured in a way that they present the information that best works for you as the business owner. So for example, expenses can be divided into controllable or non-controllable, or direct, indirect, operational or non-operational categories. It really depends on your business, your industry, what makes sense for you and how you relate to it. Performance is assessed by giving a summary of how the business incurs its revenue and expenses. So again, as you're looking at these, you want to think, wow, what makes sense in my mind? How do I need to set up my income statement? The one caveat is an income statement is only effective if you record all your income and all your expenses relative to your business. Otherwise, it's not effective at all. Here's an example. This particular one, and I chose it because it's a good middle of the road. For example, if you look at the top, under ordinary income and expenses, it's got income, and then it's got it broken down into construction income and reimbursement income. And don't get hung up on what's construction or what's reimbursement. What I'd like you to walk away with is the way it's categorized, and it's broken down that income into two distinct pots that work for this particular business. And so it takes the income, construction and reimbursement, and it adds the total, come up with total income. So all of the income that came into this company during the time period January through December of 2017, and you can see that period at the top, is comprised of either construction or reimbursement. It's not both, it's either or, added together makes the total. Now this particular one happens to have cost of goods sold too, and so they want to make sure that they pull that out at the top, because their income is really only effective if they think, okay, so this is what I made, but this is what it cost me to make that, so I want to disclose that separately. So it's total income, and they've broken down cost of goods sold, and for a gross profit of, in this case, $269,591.81. So that's their gross profit. And the gross profit is, the total income minus the cost of goods sold equals the gross profit. Then they take it and they now list all the expenses. And in this case, they've got automobile, bank service charges, insurance, interest expense, and so forth. And again, they've taken anything related to automobile and they've grouped it together. Any kind of insurance, and they've grouped it together. Interest expense, so forth. So that they can see the basic categories that work for them. And they've totaled it up at the bottom to say total expenses of $156,400. Then they've said, okay, so gross profit minus total expenses equals the net ordinary income. And that's a term that we refer to as that's really the true operational income for the business, because it's what they're bringing in minus everything that's going out on a day-to-day basis operationally. So that's the net ordinary income. Then there's things that we refer to as below the line, which means it's other things like other income. That might be income off investments. In this case, it's also interest income. It's things that where they're getting money from, but it's not really what they're generating as part of their business. And so they refer to that as other income. And so then it's net ordinary income plus net other income for a grand total at the end of this period of $113,560.69 in net income. Now, obviously, if we were to look at January through March, they might, if this is a seasonal business, they might have had a loss, or they might have had a loss during one given month, but other months they had a gain. So it's, when you're using these reports, you want to look at, okay, what happened in this month? What happened in this month? Now, if I add those 2 months, how did I do together? Because that's what a bank's going to do, and that's how a bank is going to use an income statement. It's going to look at over a period of time, how did the business perform? And so when you look at whether, in this case, you think, wow, over that year, this company made $113,000. Why would they need a loan? Well, they might need a loan to get them over a bad month here or there, because as we get on into cash flow, you'll kind of see that cash is king, and so it plays a role in this. And so that's kind of what you're looking at as you look at an income statement. It's, again, it's money earned and paid out over a period of time that you can use to compare those periods. Okay, so there's a real quick debrief of an income statement. Are there any questions on income statements before I move forward?
Troy, we've got a question about COGS. So somebody says that they're service-based business. They don't know when they would put anything into, the cost of, cost of services and expenses. So can you just kind of differentiate that?
Yes, great question, and I'm glad this came up. I picked one of these that had cost of goods sold in it on purpose, mostly so as a visual that you could see that cost of goods sold is typically recorded to reduce total income. Service industries rarely have cost of goods sold. They might, for example, if you're a hair salon and you use shampoo, you give hair shampoo before you cut hair. The cost of goods sold might be the shampoo, because you need to pay for that shampoo so that you can turn around and generate the service revenue. But like one that comes off the top of my head is someone who mows yards. Well, they're probably not going to have a lot of cost of goods sold there. They might have some gasoline, but they're probably not going to classify that as cost of goods sold, because it really is truly a service business. They just go out and mow yards, and then they come back, they charge for that, they go to the next yard. So once they buy the mower, that mower is an asset that they bought, and that's tracked on a balance sheet. So they may not have cost of goods sold. So I'm glad that question came up. Thanks for asking that. If you're a true service business, it would not be uncommon for you to not have any cost of goods sold at all. Did that answer the question okay, Jack?
I thought it sounded great.
Okay, so again, if whoever asked a question, if you need more clarification, I'll pause for a second. Please chime in and go, I still don't understand. I'll try it again.
Looks like we're good.